stop losses for zero DTs. So for zero DT options in the right underlyings, they're fast, they're liquid, and they are accessible to retail traders, obviously. The typical Tasty approach calls for high probability trades. That's like a lot of short premium. In an efficient market, the downside is there are occasionally some really bad losers. Today, so far, we've been trading in a pretty narrow range, which is a good thing.
Yeah.
Stop loss management involves closing trades that turn against us. How effective are stop loss orders in controlling downside risk for zero DT positions? And what is the cost of this protection? You want to take a guess here?
I don't even know how to quantify it. Like, are they doing by percentages, money? I don't know.
No, money, not percentages.
I don't know the number. From I don't.
Let's take a look. Do you think stop losses are effective?
I do not think they're effective. I don't use them. If I thought they were effective, I would use them.
Let's go to the next slide.
Now, I have no problem with having a mental stop, or if you want to, like during the day, you have a price that you want to get filled at on a trade that you already have on. I do that all the time.
We're going to look at selling strangles and straddles even. We're going to manage each trade at 25% with a variety of stop loss levels from 50% to 300%. From 50% means if you sell something for $1, you buy it back at $1.50, right? That's where you stop at. You sell something at $1, you buy it back at $4, that's 300%, right? Do you think there's a difference between waiting till it's a higher percentage or doing it fast?
I got to think waiting to a higher percentage has got to help you out. It's just a complete guess.
Huh? Okay.
Would you guess the same way, or would you think it would be different?
I know the answer, so I don't want to say.
Okay.
But to answer your question, I would have guessed the same way.
It's probably wrong, but yeah.
All trades were assumed to exercise at mid-price and subtract $10 to $15 from your daily P&L for more realistic results, because you're going to, there's going to be a little slippage. So let's go to the next slide. A lot of slides here, so we got to go through these. But 15 delta strangles, that's your kind of your widest strangle. And the results here, when you have a very close stop loss, you didn't make any money. Okay, it was your average was -$10 or -$16. When you had 150% stop loss, 200 or 300% stop loss, you made a small amount of money. The bottom line here was that when you're trying to collect about 25% of max profit, it's doable. You're probably better off not using a stop loss at all. Okay, for a wide strangle. Let's go to the next slide. So when we go to the 20 delta strangles, the results are exactly the same. You're better off not using a stop loss. Okay, because it didn't really help you. And
those are notes you sold at 110.02.
Yeah. So I did a bunch of notes the other day, and when I say I did, I bought a bunch of notes the other day, and I'm just selling out a little tiny bit of my position. I'm not selling any of my bonds. I'm just selling a few notes. We bought them lower, so that's actually a little bit of a winning trade. Anyway, so if you're doing the 20 delta strangle, same exact thing as the 15 delta strangles, no difference. Let's go to the next slide. When you get up to 25 delta strangles, you collect a little bit more money. The stop loss, it didn't really hurt you. You didn't make a lot of money no matter what by using a stop loss, but it didn't hurt you. All the numbers were profitable, so you could get away with it. And if you go to the next one, John, because you're going to see the percentages are almost the same. As you start selling bigger strangles, like 25, 30 deltas, 40 deltas, and you're going to see straddles, the stop losses all came out as positive numbers. You didn't make as much money as you would have made if you didn't use the stop loss, but they still turned out to be positive numbers. So go to the next slide, John. 40 deltas, I think it is. Oh, no, straddles. And the numbers are all positive. So it was funny because my takeaway from this whole piece with stop losses was that if you wanted to do kind of a riskier trade, the stop losses ensured that over time you made money. But if you didn't use the stop loss at all and you were selling straddles and very high delta strangles, your net average daily P&L was almost double this. So what it did was it cut down your net P&L by about 50%, but it did on the big numbers, on the big delta numbers, it did create a positive P&L. On the low delta numbers, the 10, 15, 20 delta strangles, it was a negative P&L. Let's go to the next slide. So here are the takeaways. Unfortunately, when it came to controlling outlier risk, only very aggressive stop loss orders were successful. Stops of 200 or 300% did little reduction in CVAR compared to management of losers. This also resulted in a lower average daily P&L and lower win rates. That's kind of where I was going to. But if playing close to the money strikes, the exchange of reward for risk may or may not be right for you depending on your investment goals to further out strikes. However, there was distinctly better performance for traders who are willing to let their losers ride. Finally, bear in mind that unlike limit orders in a fast-moving environment, stop loss orders may fill at worse price than their limit orders. That is correct. The bottom line here is if you want to use a stop loss order, you can on bigger deltas. It's just not near